Hello, everyone. Thank you so much for joining us again for another weekly wrap-up. My name is Jeremy Cronemeyer. I'm Operations Manager for Wickham Financial Group, and I have Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. Graham, what happened in the markets last week?
Yeah, thank you, Jeremy. Thanks for our listeners jumping on the call. And I'm sorry for my cold. I guess I got a summer version here. But yeah, volatility is the name of the game. I mean, we saw a pretty good rebound from that Monday, I would almost say temper tantrum that we saw from Japan. Seemed to bring the markets back. I mean, they rebounded from about a 4% drop on Monday to finish modestly lower. So the volatility, that was the highest that we saw since 2008 and also the pandemic. So when I'm talking about volatility, we might be looking at what's called the VIX. So we saw the VIX, the Volatility Index, spike above 65. That's one of the highest levels we've seen. It's been hovering unusually low in the 20s or teens, but it did revert back down to the 20s by the end of the week. So a really high spike, and then reverted back to the 20s. So if we look at what happened with the indices, we saw the S&P and the Nasdaq in marginally negative. We saw the Russell fall about 1.4% for the week. We did see the crude oil prices jump nearly 4% on continued tensions over in the Middle East, concerns. We did see the 10-year U.S. Treasury yield drop to 3.67%, and then it rebound back up to about 3.94. So some pretty dramatic movements in the bond market from that standpoint. At one point in the drama, the early part of the week, when we saw everything happening on Monday, we did for a brief time see a re-inversion of the yield curve of the 2 and 10. From an economic standpoint, maybe concerns are rising, concerns about a potential recession, maybe concerns on some labor market issues, adding to the drama that was happening in the Japanese market, which was down about, I think over the weekend, about 12%. And what was happening with the currency and the trade off of that with Japan raising interest rates. So we're looking at some data that came out from the Atlanta Fed. So they reported GDP, or their projection for third quarter. They're estimating a rise of about 2.9%. Weekly's jobless claims did see a drop. Now, keep in mind that GDP number is actually pretty strong. So that's not necessarily recessionary numbers. It just might mean that the economy is moderating a bit. Good, right? Because that can bring inflation down a little bit. So not necessarily unexpected. We look at consumer borrowing, that did increase, but less than expected. On the flip side of that, we did see delinquency rise a little bit. From a Fed survey standpoint, we did see an easing in lending standards for the commercial loans. We did see a tightening for the consumer side of the market. Going now overseas, I mentioned Japan and their stock market. Again, that fell about 12% after the Bank of Japan raised interest rates. We did see over in the Bank of Australia, they left interest rates unchanged, warned against being a little bit too premature with cutting rates at this particular point. Now, this week, a lot of economic data. We're pretty much through with earnings. Now we're getting to kind of the meat of the matter in terms of U.S. economy. Maybe some fears out there of a recession might be rearing its head a little bit. Some inflationary numbers that'll be coming out. We'll have to see if that's a concern. Do we still see a moderation in inflation? We are expected to continue to see that. We'll be looking at some CPI numbers that'll be coming out on Wednesday, some producer pricing numbers that'll be coming out on Tuesday. Then we'll be looking at retail sales. Now, why is that important? We want to check the health of the consumer. Are they still consuming goods? Are they pulling back a little bit? And I think the indication is they are, maybe on the lower income level, pulling back. Maybe the consumer as a whole is just moderating a bit from those huge spending patterns they had earlier. And then we'll be looking at wrapping it up with some Empire State numbers. We'll be looking at the Philly Fed, the manufacturing indices, industrial production. Then overseas, we'll be looking at industrial production numbers, retail sales, some CPI numbers, some GDP numbers that'll be coming out from the UK and Japan. Chairman?
Gotcha. Well, Graham, I had a question. So from a I guess, our clients' perspective, our investment clients' perspective, what can they expect this time of the year with the markets?
Well, I think traditionally this time of the year is a bit sloppier, and I know that's not a great financial term, but it's kind of the way it is. We're past earnings. We're not quite into that Santa Claus period, more towards the end of the year that usually signals a little bit better time as people prepare and get set up for the new year. So traditionally, the August, September, October timeframe can be a bit more challenging for the market, and I don't think that's not rearing its head right now. I think we are seeing more volatility that's very evident in the market, some fear with recessions and whatnot. Always like to leave with some stats and whatnot from time to time. And there's an analyst, Jim Paulson, he always puts out very interesting, points to think about. And he pointed out something since 1950, when we saw the 10-year yield decline in the previous 6 months, the next 6 months, the S&P average had an average annual return, or the S&P index had an average annual return of 16%. Now, outside of that, when the 10-year wasn't dropping in the previous 6 months, it was about just over 10.3%. Now, that is not a crystal ball here. I don't want anyone to say that, hey, listen, we said the market's going to be up 16%. But I think it is interesting to be mindful of, just because we're hearing that fears or concerns that the economy is lightening up doesn't mean that we are going into a recession. Doesn't mean that a pullback in the market couldn't get a little worse before it gets better. I think you got to expect the volatility. But again, I think it's an interesting stat that Jim put out there. So hopefully everyone could take it, run with it, however you feel comfortable.
Gotcha. Well, Graham, we always appreciate the expertise and information. And again, to our listeners, check us out on our website. We got all the weekly wrap-ups on there, our YouTube channel, all our social media channels. And also we got our Retirement Planning Today classes actually starting this Thursday at Marietta Community Schools. So if you're interested, you are a neighbor or somebody that you know is interested in that, go check out our website or give us a call here at the office, and we'd be glad to get you the information. And again, we appreciate it, and we'll see you next week.
Take care.